Hey everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings so you don't have to. Today we're diving into the New York Mortgage Trust's latest 10K, their annual report. This one's got a few twists and turns, so get ready for a roller coaster of numbers where mortgage assets meet market volatility. Let's cut to the chase. New York Mortgage Trust, or NYMT, is all about acquiring, investing in, financing, and managing mortgage-related stuff. Their goal is to give stockholders stable dividends even when the economy is all over the place. They deal with single-family and multi-family homes and also dabble in the usual fixed income stuff like mortgage-backed securities. NYMT wants to focus on what they're good at: single-family and multi-family residential assets. They think they can make better, safer returns this way. They're targeting investments like residential loans, which includes lending to people who fix and flip houses. They're also looking at the more traditional agency residential mortgage-backed securities, or RMBS, and what's called structured multifamily property investments, like preferred equity and loans for apartment buildings. NYMT are also looking at companies that help them buy these assets. They expect to put more money into single-family credit assets versus multifamily assets in 2025. Multifamily is becoming a smaller part of their plans. Since 2003, this company have been able to switch to new investments when the market shifts and to manage these assets for other companies. This is the official number that the Securities and Exchange Commission, or SEC, uses to identify this company's filings. These are the bread and butter of NYMT's strategy and include business purpose loans, agency RMBS, non-agency RMBS, and multifamily investments, to mention a few. But remember, they can change these targets over time. They get these loans from originators they invest in, or from secondary markets. Instead of servicing the loans themselves, they hire third-party companies to do it. They also own single-family rental homes through a program that provides homes to families with low income that are administered by the local public housing agencies, or PHAs. These are mainly in Illinois and Maryland. They focus on properties with 150 to 600 units, mainly in smaller cities that could use improvements. They're not looking to run the properties themselves, but instead they will participate in the project-level sponsor roles. They sold their joint venture equity investments in 15 multifamily properties, making about $16 million. As of the end of 2024, they have reduced exposure to $19.5 million over 2 multifamily properties. Their strategy involves owning primarily mortgage-related single-family and multifamily residential assets, including elements of credit risk or interest rate risk. They use debt or leverage to finance their investments. For the safer agency securities, they might go as high as 15 to 1. For riskier assets like non-agency RMBS, they aim for something between 4 to 1 and 6 to 1, and residential loans are at 8 to 1. However, they want their total debt leverage ratio to be no higher than 4 to 1. They rely on repurchase agreements that typically range from 30 days to 24 months. The interest rates are often tied to SAVA. The company's recourse leverage ratio, which is total recourse debt divided by total stockholders' equity, was approximately 3.0 to 1. They enter into derivative contracts such as interest rate swaps, interest rate caps, credit default swaps, futures, and options contracts to manage their risk. To help manage risk, they use model-based risk analysis to project individual asset price and cash flow sensitivities in different market conditions, including shifts in interest rates. As of the end of 2024, the company had 70 employees. As of December 31st, 2024, women comprised 29% of our total workforce, while 33% of our employees self-identify as being ethnically diverse. The company is committed to being inclusive in the workplace and has trainings designed to prevent harassment. The compensation committee will also take into account environmental, social, and governance performance when assessing the CEO's performance. They are subject to lots of rules and regulations, especially around lending. They also have to keep up with legislation and regulatory reforms in areas like risk management and disclosure. They must distribute at least 90% of their ordinary taxable income to keep their REIT status. This may cause them to sell assets or borrow funds to make those distributions. To avoid being regulated as an investment company, NYMT sticks to certain operational limits outlined in the Investment Company Act. A lot of their financial results depend on estimating the fair value of their assets. If their estimates are off, it can really hurt their business. The loan originators they invested in could fail to comply with laws or face managerial or operational challenges, forcing them to write down the investment. Their access to financing could be limited, which may materially adversely affect our business, financial condition, and results of operations, and our ability to make distributions to our stockholders. Repurchase agreements used to finance investments may require them to provide additional collateral, reducing their liquidity and potentially harming their financial condition. Hedging against interest rate and market value changes, as well as other risks, may materially adversely affect our business, financial condition, and results of operations, and our ability to make distributions to our stockholders. Difficult market conditions could cause them to experience losses in the future due to changes in government policies, credit ratings, or the relationship between Fannie Mae, Freddie Mac, Ginnie Mae, and the US government. NYMT can change their strategies without stockholder consent, which could lead to riskier investments and operations. The number of shares of the registrant's common stock, par value 1 cent per share, outstanding on February 14th, 2025 was 90,567,445. If NYMT fails to remain qualified as a REIT, it would adversely affect our operations and ability to make distributions. The company has extensive market risk, which means it is vulnerable to changes in interest rates and the market value of assets. They continue to expand their investment securities and residential loan portfolios. The company noted purchases of $1.50 billion of agency RMBS. They sold some joint venture equity investments in multifamily properties and are reallocating the capital from those investments to our targeted assets. Company recourse leverage ratio, which represents our total recourse debt divided by our total stockholders' equity, was approximately 3.021. Having the fair value option for most investments also contributes to volatility in our financial results period to period. So what's the take on NYMT? On one hand, they're trying to stay flexible and adjust to the market by acquiring assets with less credit deterioration and focusing on short duration assets. They're also streamlining their operations by selling off some joint ventures. However, they operate in a highly competitive market, and changes in government policy and market volatility could significantly impact their business. Plus, rising interest rates and market value changes are a risk. With this in mind, I'd estimate a fair value between $2.80 and $3.20. Given the market conditions, a hold is my personal advice. If you like this analysis, please subscribe.